Hello, I'm Rick Cloutier.
And I'm Matthew Clark.
2018 began like the last few years with U.S. stocks moving markedly higher. After a quick blip in February, domestic equities continued the rise through September, despite the slower growth in China, the potential for a trade war, and the Fed raising interest rates. Since 2015, the Fed has raised interest rates 9 times, and central banks around the globe have begun winding down their accommodative policies. Unfortunately, the effects of quantitative tightening finally caught up. The tightening of the money supply has led to the worst year for investors in the last 100 years. With over 90% of the 70 asset classes tracked by Deutsche Bank providing negative returns, there were few places to hide. Until September, U.S. equity investors remained unharmed, but from its peak, the S&P 500 dropped 19.8% when it hit its low on Christmas Eve. For the quarter, the S&P 500 declined 13.5%. So, after 9 consecutive years of growth, the S&P 500 broke this abnormal trend and declined 4.4% in 2018. Small cap investors fared more poorly, losing 11%. With a rise in rates, fixed income markets provided little relief. Short-term high-quality bonds gained 1 to 2%, but long-term, high-yield, international, and emerging market bonds all delivered negative returns. Fourth quarter GDP growth slowed from the third quarter due to a stronger dollar and trade tariffs, but remained positive. While the official numbers are not out yet, for the year, the U.S. economy expanded at about 3%, which is above its recent trend.
And although U.S. stocks avoided a bear market, some international markets were not as fortunate. In fact, trade tensions made matters far worse for many of them. The MSCI EAFE index dropped 13.8%, and the MSCI Emerging Markets Index fell about 14.6%. During the year, China's Shanghai, Hong Kong's Hang Seng, and Japan's TOPIC indexes all declined more than 20% from their peaks. Now, like the majority of traditional asset classes, alternative assets also had a rough year. Real estate was off by 4%, and commodities, led by the drop in crude prices, declined more than 11%.
So for this year, equities have moved higher, but anxiety persists due to the government shutdown, political battling between the Trump administration and Democrats, little progress in trade negotiations with China, and global economic growth showing signs of weakness. With the turmoil in the markets, the Fed ended 2018 with a more dovish stance on interest rates. The market now is predicting the possibility of an interest rate decrease in 2019. Looking forward, we expect that U.S. corporations will continue to benefit from tax cuts and repatriation, but earnings are expected to slow. That said, corporate growth remains strong and inflation is subdued, so there is little chance of a recession this year.
In the UK, political chaos continues over Brexit negotiations, and while leaving the EU without a deal would clearly disrupt UK growth, we expect that it would have little impact on the rest of the world. From a trade perspective, China is beginning to look a little better as well. This is as investors become a bit more optimistic about reaching some form of a deal. An agreement between the two, US and China, is clearly important as the impasse is negatively affecting both economies.
While concerns about slowing global growth and political discord are justified, all is not negative. Last year's budget increase means that 2/3 of the authorized spending will actually take place this year. At the same time, tax cuts for individuals and corporations actually increase. And looking at the markets, stocks are currently cheap by last year's standards.
And finally, the Fed is effectively on pause mode and unlikely to hike rates any further this year. Still, we expect volatility to remain a little higher than what we've seen over the last few years and anticipate that risk management is going to be a lot more in focus. If you have any questions about your portfolio or the information that we discussed here today, please don't hesitate to call one of our relationship managers in your area. Telephone numbers are listed here at the end of the video, and for more of our perspective on the markets, please visit our blog at watrust.com. On behalf of Rick and myself, thank you so much for watching.